Hey, welcome everybody. This is John Alexander, and this is the Deep Dive Podcast. And today I have a special guest. I've known Reid for several years now, and I've asked him to come on here because he's got an amazing program that I think everybody listening to this podcast could use if you are flipping land. So what he does is he provides the cash so that you can go purchase and close on that deal, and then he, in essence, is JVing with you in order to sell that. And you can, of course, you want to flip it as fast as possible, but he's got money, available that if it takes you 2-3 months, it's okay. If it takes you a year, it's going to also be okay. So let me go ahead and bring him on with the call today. Reid, are you there?
Yes, I'm here. Thank you for having me. I appreciate it.
Hey, this is Reid Kurtenbach, everybody. And Reid, when did we get to know each other? How long ago was it exactly? Do you remember?
I think we got to know each other maybe in 2016 or 2017, if I recall right, because at that time I had been starting to learn about land because I was buying and selling manufactured homes with land. And we had a mutual friend, Jason Matthew, who sung your praises. And I remember I was kind of teetering between, okay, do I do land? Do I continue to do manufactured homes and with land? And I was kind of trying to find my way on that point. And I also had invested in some self-storage facilities. And so I just didn't know which way to go. And I remember reaching out to you and talking to you one night about it, and you were really helpful. And that's kind of where the relationship started.
I remember that call too. So many people get started in the land business and they realize, wow, I've been in the house business or I've been in this other business, and you get into the land and you see in a lot of ways the simplicity of the transaction compared to a home or something, and you absolutely spoils you. I also enjoy mobile homes, especially if they just throw it in with land. I love that. But
Yeah.
let's go ahead and I'd like to go ahead and kind of like focus on exactly what you do, because and let me just bring up your website here for just a second so that the people who are listening can at the same time go there and kind of maybe go through this with us. So it's at parcelfunders.com. So it's parcel and then funders with an S.com. And I just kind of want to kind of do a deep dive with you today, because you do a couple of different things I found fascinating, and quite frankly, you did it very quickly. I mean, for you to put this whole thing together in a matter of a few years is amazing, and it was. A lot of people come here and they take years to get to where you got to in a matter of a few years. So I'm looking at you, I'm saying, well, this guy is doing something right. And he is, and apparently you've got all the T's crossed now, the I's dotted. I've heard a lot of great feedback from you. I've also seen you now all over the place, which is admirable. I mean, you can't go onto any podcast without finding you somewhere now. And let me do a shout out too, because I saw you do the podcast with Joe McCall, and Joe McCall is like the king of the real estate podcasters. I thought you did a phenomenal job on that. And if people want to really listen to a more full thing, I guess, with all the different things you do and everything, that I would highly recommend that podcast. What I'd like to do with you today, though, is focus in on your JV, JV offer that you can help land investors utilize. So let's go ahead and jump into that. First of all, can you explain what it is the JV is all about?
Yeah, so joint venture funding really refers to a business arrangement pretty much between two or more parties that come together to undertake a project by pulling their resources together. So when I say resources, it would be the investor, the land investor brings the deal, and I bring the money. And then we both bring experience and knowledge. And sometimes I bring more experience and knowledge, and sometimes they do. We've done over 300 plus land transactions thus far since we've been formally funding deals since 2019 for land investors or with land investors. But that's essentially the JV agreement. And so we signed something called a tenants in common agreement. And that tenants in common agreement talks through all of the different situations and what that process looks like when we fund a deal for someone, and all the, what happens, like what are the fees, who do we use from to market the property, who's in charge of what are all of our responsibilities. So I'm the type, and I think we were talking a little bit before the podcast started with this, is that communication is key. And so for me, and my wife, because she's the 51% owner, she and I really hone in on, can we connect with the person that we're funding? Is this a person that we could sit across the table from and break bread with? Because we want to be able to, when things go wrong, that's when you really find out the character of a person versus when things are all rosy. So we've been in great partnerships. We've been in so-so partnerships. And so we like to build long-lasting partnerships with the investors that we work with. And so at the end of the day, what we want to be able to do is help them completely, like, with their financial picture. So we're not only helping them from land deals, but do they have a self-directed Roth IRA set up? Do they have a self-directed 401k set up? Do they have a last will and testament? All these different things that everyone really should have set up. A financial power of attorney, a healthcare power of attorney, all of these different things that we've learned from our certified financial planners that have worked with us, that and things that they should be teaching, frankly, in school. And most adults just don't have it set up. And so for us, it's all about how can we help them in their financial life. And as we come across things with, we look at land as one piece of the puzzle for us. It's more of our short-term strategy for wealth. And our long-term wealth strategy is maybe seller finance notes, it's storage facilities, it's rental properties, that sort of thing. And so we talk to them about what we're doing. We're an open book with them because we want to make sure that they're creating generational wealth if that's their goal. And one of the first questions that I always ask the investor when I get on the phone with them, or my wife does, is, what is your why? Why are you doing land? Because you can do a lot of different things to make money, but what are you trying to seek? And then from their why, and when I'm teasing that out of them, I can figure out, okay, they need this, or they have kids, or they want to be able to spend more time with them. So then I can kind of say, okay, well, do you have a last will and testament set up? Do you have a certified financial planner set up? Or that's looking at these things, and that sort of stuff. So we're really trying to not only help them from a monetary standpoint, but also help them in all areas of their life, specifically in the financial side, because that's what gives us joy, is being able to bring everyone's education from a financial perspective up higher.
So it sounds like they're getting a bit of a coaching too when they start to JV with you. And it sounds like great coaching, by the way, because they do need all of these things. And most people don't realize that until they start to get into some, heavier business deals. And now the other business partners and everything are also, questioning, hey, what happens if this happens? What happens to what happens to our deal? Are you kind of requiring somebody to have, like you go into partnership on a JV with one particular person? What happens if that person passes away? Is that addressed in your tenants in common agreement?
Yes. Yeah, it is. And essentially what happens is I work with their heir. So whoever they are working, whoever their beneficiary is, it's common knowledge that I'll be working with them.
Do you have them sign maybe affidavit, like some type of attorney, power of attorney or something? Well, that wouldn't work if they pass away, but you just have to wait it out. If you have to, you have to.
It's
but
a
at
risk.
Least they know. I guess the upside to that is at least you're there to make sure, hey, I know how to go ahead and get rid of this property at the best price, because you're also in on it as well. It's probably a great some peace of mind even to a person that might be faced with that. Although we don't think about these things happen. And especially back during COVID. I mean, I lost some friends during that time that there was no thought ever of them dying, and here they died. So yeah, we live in a different time now. So your wife Halie and you work this thing, I guess, in tandem, right?
Yes. Yeah.
And
She's with
so
the operation, but
we
yes.
we would be, if we JV with you, we would be dealing with both of you, depending on what part of the deal, depending on a certain day, whatever might happen. Is that right? Okay.
Yeah, and we start off the conversation. Someone will submit a deal to us, and then we'll immediately want to jump on the phone with them or do like a Zoom meeting or something of that nature, just so that we put a face to a name. We get to know them, and then they get to know us. And then afterwards, most of the communication is through email, and then sometimes some phone calls. But we feel like written communication is best because you never know. So we always just kind of think it's important to, if they, and also with the written communication, it helps us be able to pull in the different title companies if we're dealing with the title company. So if someone wants to submit a deal to us for review, the process is that they submit it through the website, or if they know our email address, they'll shoot us an email, and then we'll take a precursory look at the deal, make sure that we have everything that we need to really properly assess it. And then we just get on the phone with them right away and just find out a little bit more about them. They find out a little bit more about us. And then most of the communication is done through email and generally that's good because sometimes we catch things that they may not catch with an offer. We're always kind of dissecting the offers that we get. If it comes through a realtor or so forth, or we find something that's wrong on the HUD statement with the title company. So at the end of the day, it's good to have more eyes on it, and also just keeping the communication in written format through email is great too, because it just keeps everybody on the same page.
Yeah, that makes a lot of sense too. So let's go through the JV deal. So so everybody kind of knows what the JV deal is. You're putting up the money. They're going out finding land that they can flip. You're basically funding that deal for them, and then they're going to go back into basically selling the property, and then you guys split the money at closing, basically.
Yes, exactly.
Overview, right? All right. So let's take a look at the land that you're looking to actually do a JV on. I'm going to bring up our screen here just so we can kind of see some of the stuff here. Property types: beachfront, commercial, farms, horse. I guess that's a horse ranch.
Yes.
Hunting, lakefront, a ranch, recreational, residential, riverfront, timberland, undeveloped, and waterfront. So that takes care of just about everything I've ever heard in my life about vacant land.
Yeah.
So this residential, this applies, it looks like, from a quarter acre or larger. Would you ever do a smaller deal than a quarter acre?
Yes, we would. We would consider. So right above there, it says that depending on the property, the price, and the location, we'll consider land deals that don't fit this criteria. But yes,
I got a 1/10 of an acre that I'm doing right now. I just put it up for sale yesterday for $59,000, and a few weeks ago they were selling for $49,000, and a couple of months before that they were selling for $30,000. It's crazy what land is going through right now. So one of the things, I mean, I'm glad you're able to do that because it opens up, some of these subdivisions are like, these are tiny home type subdivisions. So you're open to that then as well.
Yeah, as long as the numbers make sense, that's what it really comes down to. Is
it really more of a price thing? Do you have like a price minimum?
So the price minimum,
like a retail price?
Oh, retail price, we like to see 10,000 and above on a very low minimum with a minimum profit spread of $5,000.
Okay.
But it depends. I mean, a lot of the investors that have been with us for quite some time, they've started moving up into higher priced properties just because they feel like they're putting in the same amount of time and effort Most investors just move up into a higher price category. Generally, they're buying between 10 and 30K, or sometimes higher. I mean, we just funded a couple deals for 140,000, and so at the end of the day, um, I think what a lot of the investors are doing that we were working with are kind of operating within that 10 to 30K acquisition price.
Okay. So they're buying for 10 to 30 and they're typically selling for what would you say off those ranges?
Usually like 25. If they're buying it for 10, they're trying to sell it for 25 or higher. Low end, maybe 20 if they have an all cash offer that's very quick. And then if they're buying it for 30, they're trying to sell it for usually like 70 to 80. So it just depends. Cause a lot of the investors that sometimes they just have a buyer in the wings that they already know that will probably close on it within 30 days or less. So they're just looking for that time they're just looking for the capital to buy the property. And that's where we come in.
Yeah. And at the same time, it really solidifies your deal away from basically having to expose how much you're buying the property for, like on a flip or something. Maybe the title company gets uptight and say, "Oh no, we need to explain it to everybody."
Yeah.
So that eliminates as well. So if somebody's coming to you like with 5 acres, for example, and you're talking about maybe having to, buy it for, let's say 100,000, and you can sell it for 100, and I'm going to do a real tight profit spread here. So you buy for 100. But you can sell it for 120, maybe you get 130. Would that be a deal that you would work, or are you looking for a bigger, profit spread?
Usually we want to see that we're paying 50% of market value or less. It just depends on if they have someone that, if it's someone that I've done business or that we've done business with over and over again, and it's kind of like a transactional deal where they already have a signed agreement and we have a plan. I just get a little bit nervous with those type of properties where that's a very thin profit margin
Yeah,
because we've seen where the market will
risky.
turn.
Yeah,
And so that's my concern is that, we've bought properties where we paid 50% of market value, and then they're thinking, oh, well, we'll be able to sell it for 100K. And then we're, selling, I mean, we bought it for 50 and now we're selling it for 70,000. So we had to drop it 30 grand. And so right then and there, if I funded a deal for 100 and they're only selling it for 120 or 130, there goes the profit pretty quickly.
yeah, yeah. That was one
Especially
of
with
the things I
interest
was
rate
wondering.
rising too, right? Like who knows how the interest rate in like the new interest rate environment that we're in,
Yeah,
how that will affect things.
yeah. We still have we're still rolling the dice all the time. As an investors, that's what we do, though.
Yeah.
We just have to, and we play the game until we have to change the rules, and then we keep playing, but we're playing under completely different rules. But
Mhm.
right now, it's still you know full steam ahead until we see something. So I mean, I'm glad we cleared that up. That way, we know you know what to really look out for out there. Like if you've got something that looks like you've got one, I guess, in a way, it's going to help people buy better if they're working with you because, or especially if they know what your criteria is, because it's really telling them the kind of structure they should be getting into, because it's not a safe structure to go out there, put your money into a deal, or let's say put their money into a deal where you're talking a potentially slim profit. And if there was a market drop, potentially a loss because I've seen this in the past where people lose, Lankin can devalue, not only 20, 30%, but it can devalue 50%, like very quickly. And so we're always, you're always having to balance that in the frame. Why I'm a fan of flipping, why you're probably a fan of, hey, how quickly do you think we can flip this thing and get out of it? Because the longer you have to stay in the market, the more risk it is on your part. But to a person who's investing and is thinking about, should I bring a partner in or should I do this on my own? Or should I go get a loan, right, in my name and do it? this kind of answers that for them. Yeah, you're still risking all of those other scenarios. You're at risk, whereas they can bring a partner in like you. You're going to oversee it. Of course, you got to roll the dice like everybody, and you're willing to take that risk. And thank you for that, by the way. And
Yeah,
then we'll.
they do take the risk. I think what's really important with this piece, though, is that they're not only getting my eyes and my wife's eyes when we're reviewing a deal, but when we're going through our due diligence, each one of the investors teaches us something that we fund their deals for. So we've taken a lot of what they've shared with us and then continue to build up our underwriting. And so now with 300 plus deals that we've done and the number of investors that are sometimes doing an 8-figure business, some that are 7-figure, they're very streamlined, and we've taken the best of everybody's. And then that's what we use for our underwriting. So it's almost, I feel like they're getting a lot of benefit from that, because now they're kind of taking it through us and all these other investors that have and their vetting process. Does that make sense?
So you're bringing all this experience, which takes some of us a lifetime to get, and you kind of you've obviously gotten a lot of it in a very short amount of time. So you're able to come in there and say, okay, this is the weak point of this deal. How do we deal with that? And you probably have 2 or 3 different solutions that, while you even may know those solutions, maybe somebody even with even a few years of experience just will not know, because they haven't done the number of deals that you and Halie have done.
Going back to that scenario, though, where you mentioned the buy for 100, sell for 120, 130, I think that would be more of a deal that makes sense from a transactional funding standpoint. Especially if they know that they can turn around and sell it very quickly. Like, we have some investors like that where they don't, for those skinny profit margins, they already have a buyer in place. And so they just need our money for 1 to 2 days, and that's it.
Yeah. And so you offer the transactional funding as well, which would make it nice in that circumstance. And then maybe if you had a last minute back out, because sometimes that happens, right? Then you're still looking at the deal. Maybe the guy says, well, I have another one, but instead of dropping the deal and the deal dying, you can hang in there and probably still put the deal together.
And there's other things too that come up too. Like, we looked at a deal recently where it's right on the cusp. And so we funded a lot of deals for this investor, and we said, is there the opportunity for you to go back to the seller and say, hey, did you know about X, Y, and Z? When I talked to my funding partner, they found this and this. Like, a lot of times we find a lot of hair on deals that investors aren't aware of or don't think to look at or look for. And so it gives them some more leverage to go back to the seller to say, hey, I did my due diligence and I found a few more things. Were you aware of this? Whether you sell to me or you sell to someone else, it's going to be brought up. And so you're going to be challenged with this. So given this information, would you be open to taking this amount of a discount or something like that?
So basically, it opens up to more negotiation.
Yeah.
Now, that brings up an important point. So when somebody reaches out to you, where should they be in their deal? Should they have it under contract already, or maybe they've looked at it and they're scratching their head over it, or what would be?
So initially, when we were getting started, and we were kind of just doing this personally in our retirement accounts, just testing it out before we started Parcelfunders, we encourage people, or we would look at deals that maybe people didn't always have under contract, but we quickly found out that we would spend several hours reviewing a deal, and then sometimes they would come back and say, the seller decided to sell to someone else. They got a better offer on another letter that they received. So then we were kind of like, that was kind of a waste of our time. I mean, initially it was great for us because we were still learning, but now, I mean, we're always learning now, but we just have a lot of deals that we review. We usually get about 5 to 6 deals a day that we have to review. or more, and it's just been steadily increasing. And so for us, we just don't have the time to review a deal that isn't under contract. So we always ask, please send us your purchase and sale agreement, because that also tells us if it's assignable, because that's important too, because we're going to be going on the deed when we fund the deal. And so they have to make sure that that language is there.
Okay. So on their contracts, it's got to say their company name or trust or their name and or signs.
Yes. Yeah.
Right.
And usually when they don't have that on there, it's not a big deal. Most of the time they can go back to the seller and just say, hey, I've got a funding partner that I want to bring in, or I got a partner and he wants to put it in his company's name, or I have another entity that I want to use, whatever they want to say. But generally it's pretty common. So as long as they're nonchalant about it, then it's not a big deal. Yeah. If they make it into a big deal, then it's going to be a big deal and it's going to raise suspicious. But
okay. And how about a deal? Okay, so as far as the earnest money goes, I'm trying to think of the best question for this, but maybe you could explain what would you expect to see that their earnest money would be on a deal like this?
Who's in earnest money?
The investor, because I teach not to put really. We put $10 on the contract, but we don't put anything in there. I just wanted to know if you wanted earnest money or you needed to see that. No. Okay, that's great.
No. Yeah, no. I feel like that just complicates things, to be honest. So for me, it's because then it's another wire fee for me. So ideally, I just want them to. Now I know that technically my attorney has told me you need to have some sort of an amount that you give them to make it conservative, whatever. But if you put it in escrow very quickly, then you should be okay. I've not had issues like that.
Okay, so let's go back into the actual deal itself. So you can actually fund up to $1 million. Is that what I'm reading correctly here on the website?
Yeah. Okay. Have we done that? No.
It's gonna be hard to find $1 million deal.
Yeah, largest deal so far is around 250.
250,000. Okay, and how big was that deal, size wise on the property?
I think it was around 45 acres, if I recall. So good metropolitan area, and very, very profitable. So because we generally don't want to pay more than 50% of market value. So. And with land being how hot it is right now, I think we sold that one for 90% of value. So
wow, yeah, that's a good deal. Wetlands, I see 25% or less. So when we're talking about wetlands, are we talking about floodway properties or the floodplain properties?
More floodplain. However, we're learning more and more about it, and there's been some deals that we've done recently that have been very profitable. So. We're pretty humble when it comes to what we don't know. We don't know. I mean, that's like a lot. And so you give me a lot of credit for, and I think it's probably undeserved because we're still learning so much. But yeah, floodplains will look at it. We just need to see that the value is there on the properties and what the exit strategy is. If someone just doesn't know that, like what would raise alarms for us is if someone thinks that if they send us a deal and they haven't checked that it's in a floodplain, but if they send us a deal and they say, hey, I know that it's in a floodplain, or a floodway, but here's my angle. Here's what our exit strategy is. That means more to me than someone that doesn't realize it and then just says, oh, I didn't know that. How do you handle that kind of situation? Then it kind of tells me where they are on their education scale, I guess.
Yeah, that can be huge. And you are looking at basically trying to do deals where they can flip them in 12 months or less. So let's take a look at the split. I wanted to maybe have you go through, because I've heard a couple, besides this split, I've heard one other split that you talked about, and I was unclear about that. So maybe you can explain to us on how the JV split is done.
Yeah. So let's start off with the JV. So 3 to 30 days. So if it takes from the time that we fund the deal to the time that we receive our money back, that's the number of days. So 3 to 30 days is a 30%, 70% split. So the investor gets 70% of the net profit, and then the funder, me, and Halie, get 30%. So after all of the fees, so realtor fees, if there's a realtor involved, title costs, everything else, anything that we've spent on the money or spent on the property, our original investment, whatever's the true net profit, that's what is split, that 30-70. And then it kind of goes up from there by 5 percentage points. So 31 to 90, 35, 65. So 65 to the investor, 35 to us. And then it continues to go up there. Once you get to the point where it's been longer than a year, according to our contract, we do have the ability to get 100% of the profit, and the investor gets nothing. Now, we've not encountered that situation before. What it says on a contract versus what we do what we do in real life is two different things. So we've had deals go longer than 365 days, but that investor was communicating with us and we were trying everything. We were strategizing. And at the end of the day, we just continued forward with the split that we were at. So since it went to the 12 months, it was 50-50. But we have had some situations where an investor, kind of like one deal that we funded, we checked in. This is before we check in, this was before we had Parcelfunders, and they kind of completely forgot that we had funded a deal for them, and it was like 2 months in, and didn't have it listed, nothing, and that kind of was a precursor to how they were going to manage the deal. And so 9 months in, he came back to us and he said, "Hey, I'm not really doing the land stuff anymore. I don't really want to focus on it. We'll just give back the property to you." And I said, "Okay, if that's what you want to do." And I think we ended up sending him some sort of money after we resold it. But our goal is not to take over the property. And the other thing too is that, we know that there's going to be some deals that are going to be home runs, others that are going to be just base, doubles, triples, and then some that are just not going to do well. But it's more about having that long-term business relationship and, frankly, a friendship with that investor where we know we can deal with some of those things. And we're all, and as long as we understand that there's not a pattern there of doing bad deals, so that's kind of, hopefully that walks you through a little bit of the chart.
Yeah, and that's actually very fair. I've done some JVs with partners who put up, fairly good amounts of money, and that was actually my agreement with them. If I can't do what I say I can do, which is sell this property within 1 year, so basically you're taking 100% of the deal and I got the lesson, right? So that's the way I look at that. And that's more than fair, because they are putting up money and now they're waiting around for a year, which really nobody should wait a year. Obviously, I'm sure most of your deals are done within a month, 2 months, 3 months, because that's probably land being what it is right now is going actually quickly. And if it's taking longer than that, somebody's dropping the ball somewhere, right?
Yeah, I agree. And I know investors or funders that are 6 months, and so after 6 months, they take it back. I'm not like that. We understand things come up. People have personal issues that come up. Life happens. And so for us, if we see a long-term relationship there or a potential for one, good times, bad times, we'll be there for you. So.
Yeah. And that's an important point because, this relationship building you're talking about, when you start to form these relationships and it's bonding basically over a money transaction, the trust level for both of you go through the roof if both of you have done what you said you did. And who do you really want to go back and deal with? Because now they're predictable. For me, the worst thing possible is if I don't think I can predict what a person's going to do. That makes it where I don't even want to do any business with them. So when you're building this relationship, that even gets stronger, and you find that you can actually do more deals together. it's a lot simpler. The first deal is always going to be the hardest because you got to overcome some barriers yourself. Like, okay, I found this deal, I got under contract. Should I call Reid, or should I just try to do it myself? Is there a simpler way to do this than maybe bring in Reid and kind of go with what he's talking about here? Whereas you've got to, in a way, you've got to say, you know what, long term, I better bring Reid in now. This is a nice, what I think would be maybe a great deal, simple deal. This is a great deal to bring Reid in so we can build a relationship. So when I get to some heavier deals, Reid knows me. Reid's going to step up, and we can maybe make some deals maybe I couldn't do without Reid on the deal.
Yeah, and I appreciate that a lot of the investors can say, okay, well, I can fund this deal on my own, and that's fine. And I get that. I think you hit the nail on the head there with starting out with the smaller deals, because if someone approaches me with a $150,000 deal initially, and we've never done any business with them, we're going to really, we would take it through the same process, but it's going to be something where it'd be much easier if it was one that they just approached us about a $20,000 deal or $30,000 or whatever it is. I think that's key too, is just being able to look at that.
Yeah, I know. My comfort level is always better. If you baby step with me, we'll go a lot further than if you come in and say, "Hey, I've got this $100 million deal." I'm going, I don't. Who are you, first of all? And now I'm going to do all this research on you to make sure you're legit and everything. And if you have a relationship already built up, none of that really comes up.
Yeah, and one of the things that's interesting too is that we found lately that, well, I'll give you an example. One person starting about a relationship and how important it is to not only so I'm vetting the investor, but I want them to vet me. I think that they should really ask me any questions that they want. And if I start getting skittish about something, or say, I'm not willing to share a proof of funds that shows that I really do have $1 million in the bank, certain things like that, then I would kind of question who you're dealing with. Because I'll give you an example. We had an investor that approached us. They were supposed to close, I think it was like 7 or 9 days before they were supposed to close. And an investor that I had never worked with before, it was a $140,000 deal. And he said his funder pulled out, said, "Yep, I'm good to go. And he was going to lose the deal if he didn't find the money. We luckily were able to vet the deal. We funded the deal. Everything is good. And now it's under contract, and we'll probably have it sold by the end of this month. I think. I don't have the information in front of me, but I do know that one we will be selling. It's under contract. And it's a neighbor that's buying the property. So it's a great deal. But as an investor, you just want to be able to have some predictability and some trust. Not only I need to be able to trust you, but you need to be able to trust me that I'm going to follow through. And unfortunately, this funder bailed out. And we do get a lot of funders that say, "Yep, I can fund this deal," or they tell investors that they can fund the deal, but then they contact us and say, "Hey, I don't have enough capital. Can you fund the deal for us?" And then we'll be the front facing, and we're like, "It's just not how we work. I'm sorry. We don't mind co-funding with you, but so make sure that the funder is not like a 1-2 deal and then they're out. You want to try to strike up a relationship with someone that actually has enough capital to continue to do deals with you for long term. Like, our goal is never to run out of money. And so far, knock on wood, we have not done that, and I don't foresee that happening.
Good. Well, it sounds like if you can do $1 million deal anyway, you're well capitalized for doing these with some land flips. Now, before we go, I'd like to know: do you have like a case study that you could kind of share with us and go through an actual deal so we can kind of see it start to finish?
Yeah. So let me give you some background on it. So I signed NDAs with all of our land investors, so I can't tell you exactly where it is, but I can say it was 14 acres located in the south. It was private property with neighboring homes. There were no restrictions. It had legal access, and there were utilities on the neighboring lots. And let's see. The numbers, the way that it panned out was that the purchase price was $59,242.98. That included the purchase price, the closing costs, and the flat fee MLS cost. The estimated sales price was $160,000 is what the investor projected. We actually ended up selling it for $143,325. The funding date to disbursement date, so when we funded it to when the money came back to us and the investor, was 81 days. So the due to seller, which shows up on the HUD statement, after all broker fees, closing costs, taxes, a delineation study, was $133,484.82. So if you subtract the original amount that we paid for the property, which was $59,242.98, from that $133,484.82, it was $74,241.84 of net profit. So in this case, the way that the numbers worked was that this is when we started, we did like a 45-55 split on this one. So we took the 45% times the $74,241.84. And so the net profit for us was $33,408.83. The net profit for the investor was, if you take the 55%, was $40,833.01. But when we factored in all the costs and everything like that, if we go back to our new profit split, which it would have fallen within that 31 to 90 days, the investor actually, in this case, would have gotten $48,257.20 because he's getting 65% of the net profit, and we would have gotten $25,284.64 because that's 35% of the net profit. But I wanted to be very open and honest about that because we had a different split beforehand, which was a 45-55% split. And then we've changed our model, so it's a sliding fee. So the longer the property takes to sell, the more money we get, the less money the investor gets, and vice versa. So it's advantageous because we're always about velocity of money. But that's generally what happened on this deal. And this deal was interesting because it was we had to do a delineation study on it, and because there was wetlands on it, and the wetlands map, the national one, showed a different look of the wetlands and what part of that parcel was the wetlands, and then the county had a little bit different map too. And so we ended up doing a delineation study because that was very important for our buyers. And that cost us a little bit of money, but it wasn't too bad. And we ended up making a decent profit, as you can see.
So obviously that study would add to the value of being able to sell. So who paid for that study?
Me.
Obviously you being the investor, I'm assuming it was you.
I funded, as the funder. Yeah, I paid for the delineation study.
Okay. And by the way, how much was that?
I think it was. I think it was a little over $1,000.
Okay. So when extra fees come up for something unforeseen, being the funder, that's kind of on you, right? To come back in and fund the rest of the stuff that needs to be done.
Yes, sir.
Yep. Okay. And that's why you earned the fee. Okay. Well, hey, by the way, that was a great profit if you think about it. This investor made almost $50,000 on this deal in about 3 months without putting up any money.
Well, the money that he put up was for the letters, the mailing, that sort of thing. But when I talked to him about what he really had invested with his time and stuff, he said probably about $1,000. But I don't know where else you can get a return like that. $50,000 on $1,000.
Yeah, I mean, for sure. So, by the way, I had heard that you also will pay for mailing. Are you doing that? Are you still doing that?
Yeah,
okay.
Yeah.
So you'll work with investors and pay for some of their advertising and what? How does that work?
Yeah, it's really simple. So as long as we have some experience with them and we've done maybe a few deals with them, usually it's 2 to 3, and we see how they're doing their deals. Essentially, we will pay for their mailer, and then when any deals that come back, we get first rights to fund any of those deals. Same sort of split. There's no, and after the first deal, so the first deal that comes in, if there's enough net profit, we get paid back all of the money that we spent on the mailer, obviously what we spent on the buying of the property, and then whatever's left over is just the normal net profit split on the website. So that's generally how it goes. There's no, for us, it's just more of we're helping them out, and then we're helping us out because it gives us a solid more line of deals to fund.
Right. So you're picking up that like that. They automatically need to come to you on any deal. So if they see a deal and it's even if they can do $1,000, if they can buy a deal for $1,000 and they have the money, they still have to bring you in on it if they do, and that's more than fair. Because now when they do get to that $150,000 deal, you're also going to be there.
Yep, exactly. And then one other thing that I didn't mention is that we do have a really unique thing about us where we have a loyalty program. So basically, the more deals you do with us, the more you'll actually save. And there's different tiers. So I would encourage people, if they are at all interested in seeking funding from us, or if they're looking at another funder, ask them, do they have a loyalty program? Is it more of just, if you do 1 or 2 deals with me, I'll give you a better split. We approached it that way in the beginning, but then when we came up with Parcelfunders, we thought, no, we need to be more transparent. We need to treat everybody the same, because we have some people that we said, well, if you do 1 or 2 deals with us, we'll give you a break on the percent, the fees. But some of those people that bring us 1 or 2 deals a year, that's all the deals that they do, because there's usually 100 to 200 grand profit. So it's like, and then we have some that bring us a lot of deals, but they're maybe 10, 15, 20 grand net profit. So we wanted to keep it very fair, no matter, and we base it off of the total net profit that we earn from that relationship from a funder's perspective. So I would encourage people to look at that. And then also, from a referral program standpoint, we give incentives to our investors that refer us, and to them specifically, as well as to the people that they end up referring us to. So, and lastly, I guess I'll just say is that, our time is really limited, but I love to geek out about land and talk about land. So even if someone just wants to, give me a call and just talk with me, my phone number is all over the web, so you can give me a call and just talk. I mean, I love chatting about it and texting and just helping people. But I would say you got to, whether or not you click with me or you click with another funder, just make sure that they're going to show up when they need to show up, and they're going to be dependable for you, because that's what's key. Because your reputation is everything in the industry, I feel like, and so especially with these sellers, and so you want to be able to come through, and you don't want to lose out on a $50,000 deal because the funder can't do the deal with you.
Yeah, and if you try, you're losing dollars trying to pick up pennies when you should probably go with somebody like you that will be there, when you need to be there, which is important. Well, I'd like to thank you so much, Reid, for coming on here, sharing your knowledge, sharing, how we can work with you to put our deals together. And we know that you and Halie will be there. You've got our backs. You're going to overlook our deal and make sure we're not screwing up somewhere like, we all do. Even I do. After 40 years of it, you just, you're always learning and you're always still making mistakes. So it's always good to have another set of eyes. And I think your eyes and Halie's eyes would be great on these deals. So again, thank you so much. And for those of you who are watching this or listening to this on the podcast, please leave us a review. That really helps our ranking. And also like the video wherever you may see it. Thanks, everybody. We'll see you again next time. Thanks, Reid.